Hello, everyone. Welcome to the final bar. Today, we're going to talk about a market selling off in the first hour or so, but really trudging higher through the course of the day, with the S&P managing to finish in the positive after showing some distribution early on. What does this mean for the overall trend? Well, it's all about the individual names and sectors. We're going to break down a lot of each of those. We'll talk about some sectors making new highs and whether or not you may want to be allocated there or be looking elsewhere. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the activity in the markets using the power of technical analysis, the power of stock charts, focusing on how we visualize investor decision-making by looking at trends and momentum and breadth and sentiment, all the tools in the technical toolkit. You know, today, earlier on, I'm thinking of this as a distribution day. I'm seeing stocks like Apple that, instead of breaking out of patterns to the upside, are kind of coming more mid-range of where they've been recently, sort of working up this whole thesis in my head. And by the end of the day, pretty much all of that erased, with stocks resolving to the upside just fine. So if there's any doubt that we're in a bull market, days like today certainly either reinforce the euphoric nature of the current market environment or the consistent nature of the bullish market, depending probably on which side you come in on, in terms of whether this is unusually euphoric or unusually normal that we would continue to push higher. At the end of the day, we have to focus on the trends. The trend is positive, and we've seen that by the fact that the S&P keeps making new highs. However, as we've talked about before, I'm not struggling to find stocks that are breaking down. Plenty of stocks testing their 200-day moving averages even today. So it's not completely in the clear. It depends on what area of the market you're looking at. We'll look at all those, as many of those charts as we can together today. We have great guests on the show. Last week was a lot of fun with some of our guests. This week, more of the same. Tomorrow, on Tuesday the 17th, we have Sean McLaughlin from All-Star Charts. On Wednesday the 18th, Jay Soloff from Investors Alley. On Thursday the 19th, Larry Berman from ETF Capital Management in Toronto. Coming up next Tuesday, Kathy Donnelly, founder, proprietary equity trader, and author of The Life Cycle Trade. Also, I'll be doing a free event coming up tomorrow on Tuesday the 17th, 1 p.m. Eastern, all on relative strength investing. I've called this presentation Relative Strength: Top Performers Make Top Portfolios. You can find more info on that free event at my website, marketmisbehavior.com/relative strength. I'd love to have you join me for that free event. Let's continue on with today's market recap. As we've mentioned many times on Mondays, if you've not joined us before, we hit the market from three directions. We start with a top-down macro environment, focus on some of the key big picture charts, and then talk about sectors and look at some of the sectors on the move, rotating higher, rotating lower. After the break, we'll do a segment, Shifting Stocks, where we focus on some of the key charts at key moments. And there's so many stocks, obviously, we could look at. We look at a small number, whatever we can get to highlight some of the key charts I think you should be aware of this week. Starting with the big picture environment today, the S&P, as I mentioned, really turning things around, selling off in the morning, but then rotating back higher, bouncing off the 4440 level to close all the way up near 4480, which is an impressive move to the upside, a nice new high there. The NASDAQ actually moving a little bit lower. The NASDAQ 100 was flat. The NASDAQ Composite down 0.2%. Mids and smalls both down today, with the small cap index down 0.5%. The VIX is still just a little bit higher, back to around 16. Other asset classes very quickly, interest rates coming off. So Friday you had interest rates coming lower, with a 10-year yield down to just around 1.3% today, coming down even further, finishing the day around 126 or so. And again, the movement in interest rates has a lot of potential implications, especially now as we're talking. I talked to some of my guests last week about inflation concerns. Samantha Leduc had some great thoughts on that, talking with Matt Tuttle on Thursday about risk management and how you deal with the uncertainties that we are all faced with, coronavirus and economic implications or potential implications. So interest rates are certainly a key chart to watch. And for what it's worth, coming down again today with bond prices going higher. The dollar index remains relatively stagnant around similar levels. Precious metals moving higher today, but the rest of the commodity complex, for the most part, finishing lower. And energy was the worst of the 11 S&P sectors, although we'll come back to that momentarily. Cryptocurrencies, as always, quite volatile. Bitcoin is settling in just below 46,000. This is after bouncing higher over the weekend into today and touching 48,000 yesterday and into overnight before today's day session. Let's look at a big picture through a series of charts. The S&P 500, you saw, it was fascinating. You saw before I refreshed the chart, that was when I first brought things up, and you can see that things were down a little bit. By the close we're up, and this is a great reminder that the final bar, in quotes, the actual final bar, the last bar. Remember, when that's highlighted on StockCharts, that's an active bar that's currently trading. So I would always caution you to draw too many conclusions before the close is locked in. That's when the bar, the candle, is confirmed. That's when it actually represents what happened. Until then, it's showing you the current environment, but it can, the picture can change very, very fluidly, as we saw with the day like today that opened lower and then closed higher. So overall, this turned into a continuation day, new all-time high for the S&P, new closing high for the S&P. And as we've mentioned many, many times, I think the path of least resistance on this market is higher until proven otherwise. We can talk about all the reasons why that should or should not continue, but the fact of the matter is it seems to continue. So we have another month, August, with a new all-time high. That's been every month so far in 2021. Really, since last November, that's been the case, which is a pretty impressive run for the S&P 500. We talked about this bearish divergence here in July going into early August. We had a similar bearish momentum divergence in April and January. Those other two times resulted in a pullback around 4 to 5%. We really didn't get that at all this time. We pulled back about 1 or 2%, and that was barely it. So really not much of a pullback. So when people talk about the market being overdue for a correction, it's that sort of thing. When it's shrugging off things that would traditionally be a fairly straightforward negative signal, a sign that a pullback was due and imminent, just really hasn't followed through with that. And so you see a lot of stocks just resolving to the upside, and the market itself doing that same exact thing. So when we continue to make new all-time highs, you can't be too negative. You should not be too negative. The momentum potentially eliminating this bearish divergence. We're now seeing higher momentum than we did in July. So I can't consider that sort of an active signal anymore. At this point, I see the market moving higher. The 50-day moving average currently around 43.35, 43.40 would be the line in the sand on any sort of pullback. It's about 4 or 5% below current levels based on my quick eyeball analysis. So that would be a reasonable pullback and still be within the framework of this long-term uptrend that we've been witnessing here. We talked about cryptocurrencies a number of times last week, and I put a couple of videos on my YouTube channel called Market Misbehavior last week, talking about how to consider the next steps of Bitcoin. One video talking about the 4 potential future paths, the second one sharing which one of those I thought is most probable, and then giving you some explanation. So check that out, my YouTube channel, if you want more detail on that. But just the overall basic takeaways, I think this pink shaded area, which is sort of 42 to 44,000, that's based on previous resistance levels. That's also based on a Fibonacci support level, which has served as price support before. There are a lot of reasons why we're sort of keying in on that price level. That's where we bounced off here at the end of July before the leg higher, which we are still in the midst of. And I think remaining above 42,000 is really key to that overall constructive thesis. I'd be watching that bearish divergence. We saw bearish divergence in stocks that did not play out, and I would be looking for it here though. And again, any divergence, it's on my list, and a breakdown could be a potential signal. We'd have to break below the most recent lows, and 42,000 again remains the key level to watch there. Very quickly, elsewhere, we talked about gold, and gold has been quite on quite a move. And when a market is volatile, I always encourage people to take a step back, look at the big picture, think about the trends and the highs and the lows. And what I see in gold is a pattern of lower highs and lower lows. Most recently, about a week ago, we made a new swing low. We undercut the June low. Now we're trading back up toward that region. And the question would be, can we eclipse the previous highs around 171 on the GLD? That's sort of the level. And I think if we break that, that's fairly encouraging for a move to retest those previous highs around 179. However, though, that is a significant resistance level. And again, we've been making lower lows. The question now is, do we continue to make lower highs? That pattern, I think you assume that that's going to continue until proven otherwise. So a couple charts really at key levels, with gold bouncing off the long-term lows, with Bitcoin testing, breaking out above 42,000 and now testing that range 42 to 44,000. Does it remain above that? key level. Our next segment today is sector setups. We talked about the big picture and talk about the overall market moving higher. What were the sector movements today? We have healthcare higher than utilities, than consumer staples. Two of these, utilities and consumer staples, I would very much bucket in the defensive category. Healthcare is kind of on its own, to be honest. I think there's some offense and really some defense in that sector. So I don't know if you can necessarily call that one or the other. On the downside, you have energy, materials, so some of the cyclical sectors at the bottom of the list, followed by consumer discretionary, which was third from the bottom. You know, it's interesting when you're looking at sectors. A couple of things we're going to do is look at the RRG, the relative rotation graph. We'll also look at some of the individual sector charts, because I think you have a scenario right now where you have some sectors that are going higher, but the question is really, is that where you want to be based on their prices breaking out? And I'll show you what I mean here in a minute. I was looking at the RRG earlier today, and we're using weekly data for the relative rotation graph. As a reminder, if you've not used this visualization before, the idea is that the sectors rotate around the benchmark, the S&P, which is here at the crosshairs. Further to the right means a stronger relative picture. Further to the left means a weaker relative picture, and the vertical sort of gives you the second derivative of that, or the momentum behind those relative trends. If you're not very familiar with this methodology, Julius DeKempner, one of our contributors, designed this years ago and has done a great job demonstrating its value. His show is called Sector Spotlight. I'd encourage you to check that out for more color on it. But what's interesting is I was actually looking, the last couple of weeks, we've talked about this rotation away from the cyclical sectors. Here's energy, financials, materials, industrials, all heading southwest, what I call the direction of deterioration. All the financials are popping up just a little bit, materials just a little bit, but overall still in a downtrend, and now all four in the lagging quadrant. Now, this is using weekly data, so it's more of a long-term picture of the rotation, but it really shows the relative weakness in those four sectors and the improvement in two key sectors, technology and healthcare. And what's interesting there is when I'm screening for ideas, and I do that a couple times a week, just looking for equities breaking, making new swing highs or new swing lows, or looking at particular buckets of stocks, I am not struggling to find improving or strong charts in really three sectors. One is technology, one is healthcare, the second is healthcare. So not surprising to me that the two are there. The third one, to be honest, is consumer discretionary. And I'm not super surprised by that, only because consumer discretionary is a super diverse sector. Some sectors are fairly homogenous, like energy, right? While there are some different business models represented in the energy sector, a lot of it is just based on oil prices and the implications there. So, it's most of the stocks there tend to move in a relatively similar fashion. Something like consumer discretionary, it's a mashup of a lot of different businesses and influences and cycles. So I'm not surprised to, you usually find good breakout candidates and good breakdown candidates in a sector like that, because there are a lot of different themes that are represented. We'll look at a couple of those if we have time during our shifting stocks segment. What's interesting, though, is I was looking at the visualization at the bottom. One of the things you can do is resort this table. So this is starting off showing the 11 sectors very simply, I would say very crudely, in order of their relative attractiveness based on the RRG, because it's starting in the leading quadrant, then the improving quadrant, then the weakening, and then the lagging. So in that order, and showing you the strongest tail movements within those four. And you can see that it's focusing on technology and healthcare. So if you want a quick view on what are the strongest sectors based on the visualization, this is a great way to do it. But if you sort it over here, what you can do is sort it on the percent movements in the sectors. And this is using weekly data, as I mentioned, and then you can see how that stacks up relative to these other other visualizations. So what I can see is for the 4 weeks ending August 16th, I can see the changes here on the right, and I can see that the most beaten down sectors, these cyclical sectors that have been weak, are the ones that had the strongest short-term performance. Just looking at the last, basically the last month of data. So the fact that all these red sectors are here at the top shows me that the biggest improvement has been sort of a mean reversion from some of the weaker sectors there. Some of the cyclicals, things like financials and materials, that have had nice bounces relative to where they've been. Again, this is not based on anything other than the change. It's all based on the relative performance of these 11 S&P sectors. So let's look at a couple of these just using the candle glance function. So this is where we can basically pile all the charts up on one table here and see which are strong, which are weak, and which ones are at key junctures. What draws my attention here is you have a separation between the sectors that are working, which sectors are above 2 upward sloping moving averages. And at this point, it's most of them, almost all of the 11 S&P sectors are above their 2 moving averages, except for the energy sector. And the XLE is clearly the weakest out of the 11 based on the trends. It's the only one below its 50-day. It's the only one where the 50-day moving average is clearly sloping downwards, although financials is kind of in that bucket. And maybe materials, but this one is clearly the worst performer of the group. And it's interesting, as I'm screening for stocks, I'm going through the S&P 500, probably the sector that was most underwhelming in terms of a lack of good breakout charts or lack of strong charts, and a plethora of weaker charts would be the energy sector. And the average chart kind of looked like PSX, not to jump too quickly into the shifting stock segment. This is what the average energy stock kind of looks like right now. It's not horrible. I mean, these things haven't completely ruptured, but they certainly appear to have rotated from a period of strength in the first, quarter or two of this year to more weakness. A lot of these made new highs earlier in this year and now are rotating and making new swing lows. PSX in particular broke down through its 200-day moving average, trading higher. Now, once again, potentially breaking lower out of this bear flag pattern, which is what I would call this, maybe a pennant. I'd have to debate that one, I think, with myself, but overall, certainly a consolidation phase after a sell-off and then sort of breaking a trend line using the previous lows. Overall, I would expect a chart like that. The path of least resistance seems lower there, and certainly the relative strength has been weak. So out of the 11 S&P sectors, if you asked me to identify one that was struggling and I think would be the least opportunistic, energy is probably most likely what I would tell you. So let's look at the other side of that. Which ones are the most strong? So I'm immediately drawn to 2 sectors: consumer staples and utilities, both of which have had nice runs to the upside, broken above previous swing highs. Kind of impressive run. Here's the challenge with consumer staples is the fact that the relative strength is still so bad. So even though the sector is making new highs while other sectors are not, you have to remember, based on the trajectory of this chart, based on the stocks that make up the sector, you see the relative strength really since the March 2020 low. You have not been paid to own consumer staples by any means. I mean, it's just not been a great sector to own. Now, that's not to say within the consumer staples sector there aren't charts that are kind of working. And after the break, we'll start with the consumer staples sector. I'll show you a couple charts that could be good opportunities within the sector. I think there are plenty that could be interesting, but it's just the average. The weight of the evidence in terms of the overall sector is less attractive. Utilities, the other one breaking to new highs. I think this one's a little more constructive, but still, both of those are ones that have had relative underperformance. They really haven't performed well on a relative basis. So it would be difficult for me to suggest that there's opportunity there, as opposed to the XLK technology, which is also making new all-time highs today, which has also been outperforming for the last couple of months. I would much rather own things that are outperforming than those that are underperforming. We need to take a quick break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show. We're going to get to our next segment here in a moment, but a couple of quick announcements before we do so. Number one, we love to hear from you. Questions that are coming up as you are analyzing your own charts, because we are here to help. We have the Final Bar mailbag where we can gather your questions and we will answer them tomorrow on Tuesday's show. You can get your questions to us one of 3 ways: via email, thefinalbar@stockcharts.com, via Twitter, @FinalBarSCTV, via YouTube. Just put the comment below the video that you're watching on our Stock Charts channel. We would very much appreciate hearing from you, and we'll hope to answer your question on the mailbag segment tomorrow. Also, go to StockChartsTV.com. Use your email address. You can set up a free account, immediately start watching all of our great content. Fantastic guests like we had last week with Samantha Leduc, Matt Tuttle, many others. Wonderful specials like Charting the Second Half and The Pitch. And also great shows like the Final Bar and others. Go to StockChartsTV.com. You can also search on the App Store on your mobile device for StockCharts TV on demand. Continuing on with our next segment, Shifting Stocks. We talked about the big picture, the S&P continuing to push higher. We didn't talk about the market trend model, although we did on Friday. It remains negative for me on the medium-term model, which is tough to digest, tough to accept as the market keeps going higher, but it reminds me to remain cautious and think about potential downside. And I think in areas like energy, that's been a pretty decent way to go about it. With sector setups, we talk about the strength in a number of sectors, but to focus on relative strength, and again, my webcast coming up Tomorrow on Tuesday, the 17th, we'll dig into a lot more detail on relative strength. So again, go to my website, marketmisbehavior.com/relative strength if you want to join me for that. On this third segment, we're going to talk about shifting stocks and focus on some of the individual names that I've screened over the course of the last couple of days, things that I think are opportunistic or worth paying attention to. We finished the last segment talking about one sector in particular, consumer staples. And I think what's difficult about a sector like consumer staples is even though the price has actually appreciated, if you look at the XLP, so overall, it seems to be an attractive option when something's making new highs. On a relative basis, it just hasn't really had the relative performance because other sectors have just been performing much better over the long term. So while I would continue to think of consumer staples as a fairly poor place to allocate, thinking of sector rotation, I do think there are opportunities within all of the 11 S&P sectors, including maybe not energy, but including the consumer staples sector. KR is one of the stocks that I would highlight in the XLP or as a member of the consumer staples sector. You know, I like the chart overall. It's made higher highs and higher lows. I like the trend above the 50-day moving average, which is encouraging, made another all-time high today. But I especially like the relative strength, which is starting to go up. So in a sector that's struggling, especially relative to other stocks in the sector, it's a really decent trend. But even relative to other stocks altogether, not bad. Now, there are others. Costco is probably one that we've highlighted the most in terms of a representative stock within consumer staples that is a strong performer. Costco is probably the best example. COST, another one. Maybe Philip Morris would be the one. In terms of opportunistic breakouts, this is something that's just made a new high on Friday, followed through that to the upside today. And while the relative strength has been a little weaker in the short term because it's stabilized here, I like the fact that it's once again breaking to new highs. So even within consumer staples, which I think overall is something to think more of as an underweight if you can, I think there are opportunities within each of the sectors, and those are three that come to mind within consumer staples. There are others like PG maybe comes to mind as one that's breaking out of resistance, or potentially I think watching those highs from October and November could be of interest. But again, focus on the relative strength as much as you can. I also, just another observation as I was going through the S&P 500 stocks earlier today, I'm struck by two charts in particular, mega cap FANG names that we've hopefully, I think, widely followed, Amazon and Netflix. And what struck me looking at this chart is it's now been over a year and these charts have literally gone nowhere. On an absolute basis, we are almost identical where we're at right now to where we were a year ago, even more so. I mean, going back to July, who would have thought in July of 2020, as the stock was going higher, that would be it. That pretty much, if you bought there, you'd be flat for the 12-month period, 13-month period if you bought it there. Now, while that doesn't feel that bad to not be losing anything, here's the problem: is the relative strength has been horrible, but because the market itself has made higher highs and higher lows, continue to push higher. The average stock has done better than this. There have been plenty of names and plenty of opportunities across sectors which have done better. But it's worth noting that when a stock stops making new highs and others don't, or others are able to make new highs, you really want to focus on. I think the relative strength turning lower again, I think, was a key tell on the chart of Amazon. Same with Netflix. Here's another stock that's literally sideways for the last 12, 13 months. So it's interesting that while the market has gone higher, it's not been everything, right? There have been names like Amazon and Netflix that have not done well. And again, on a price basis, you can see the highs are not getting much higher. The lows are sort of stable. These are sideways trends. But I think the relative strength tells you all you need to know about the weakness there on a relative basis. Just not good opportunities relative to what you could get elsewhere. Other things to hit on, just a couple of random charts that I think are in interesting setups. We talked about Regeneron recently, and the healthcare sector. I'm not struggling to find new ideas as I'm poking around there. RAGN is just this classic rotation from distribution phase to accumulation phase. Again, this is one where the relative strength has gone from steadily underperforming to steadily outperforming. And I like the rotation higher. Again, it doesn't continues to make new swing highs. It continues to accelerate to the upside, which I would say is overall encouraging. Within the industrial sector, I was impressed by a chart like Masco, which has had a nice rotation as well. Now, this is a stock that pulled back to its 200-day moving average. There are a number of stocks that are pulling back to their 200-day, and we'll hit a couple of those here in a moment. But I like stocks that were able to bounce off of their 200-day and now rotating back to the upside. bounced off of its 200-day, bounced off of the 50-day, and now rotating back to the upside. So based on that strength, I don't think it's unreasonable to expect a retest of those previous highs, which is about let's call it 5 points above where we're at right now, which is not a bad short-term run. Then the question will be, obviously, do we have enough momentum to get above that previous high? But I like the fact that the lows are getting higher and the relative strength is starting to turn higher. That's pretty impressive. Finishing off within the consumer discretionary sector in particular, there are a number of stocks I would argue at key support levels. And sorry, I'm reaching over for this notepad over here. In terms of earnings this week, we're sort of out of the bulk of earnings season, but it's a lot of the big box retailers, most of which are in these two sectors, consumer staples or consumer discretionary. Walmart, Home Depot, Target, Lowe's, TJ Maxx, Macy's, Kohl's, these Ross Stores, these are all stocks reporting, and then Foot Locker, all reporting this week. And so I think there are potential catalysts for some of these charts to rotate higher, but there's also, potential for things to miss. And I think Gap is at a very key support level, similar to the chart of Disney. I think these are in similar buckets where they've had a period of outperformance. They've now settled back in and have been more sideways. And the question is, do they rotate higher after finding consistent support? For Disney, it's at the 200-day, it's around 170. For Gap, it's a little above 26. We'll call it 26, 27, where it's bounced a number of times. It's also the 200-day moving average. It's also the support from March. It's also the high from November. So there's a great importance to that level right there. I think we're really close to this breaking down and starting to look really negative. So while I see the market going higher, when I'm looking for pockets of underperformance or where there are opportunities to underweight or opportunities to lean away, it's stocks like Gap and Disney. I hate to say it, stocks like Tesla, things that are testing support, testing the 200-day moving averages, not able to break out to the upside. And I think those are levels to watch. Great idea to, by the way, upload a chart list, set an alert for when those stocks break their 200-day moving average, which you can do on our alert system. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the new Dow theory. I talked about the transportation index on Friday, and one of the tweets that I sent out generated a little bit of disagreement. I would say healthy feedback in terms of using the traditional Dow theory, and I totally get it. I will acknowledge that using the Dow Industrials and the Dow Transports as the two main pillars of the economy is a very dated way of thinking of it, and Charles Dow had a very different intention. That's why what I call the new Dow theory looks at the S&P and the NASDAQ, and I think that plays to what Charles Dow was thinking when he first came up with the idea of comparing the performance of indexes representing different parts of the economy. I think there's a better representation of that. When you look at the new Dow theory, things are fine, making new highs and new lows until proven otherwise. That's a fairly bullish setup. Chart number 2 is the consumer staples sector. As I mentioned, I would always be impressed by stocks or ETFs making new all-time highs, but I would be wary when the relative strength is underwhelming, right? Charts making new all-time highs, but where the relative strength is weak, still, I would argue, do not deserve your attention or your capital. I would be focusing where there is improving relative strength, because that tells you you're doing better than just parking in a passive product. Finally, I mentioned Tesla in our shifting stock segment. I wanted to highlight another related chart, ARK Innovation Fund, ARKK. Now, this is one, when you look at the price on a price basis, a fascinating chart. Right? This bounced off of the first Fibonacci support level in March, came down to the 50% level, which is just around $100 a share in May. From there, bounced higher. Now retests the resistance level, the previous resistance level from March and April, right around 130, and failed. And from that moment on, for the last 6 weeks, it's gone nowhere near the 130 level, or not enough to certainly eclipse that. We talked about that as completing this rotation. We were in a downtrend, then we're in a sideways trend. Can we break above that? And this is setting up to be what's called a head and shoulders bottom, which is a low surrounded by higher lows, but you have to break the neckline. So until it gets above 130, I still see this as a fairly weak chart, especially on a relative basis. And I think that's the most important indication. In fact, the relative strength making a new swing low today is an important thing to watch out. In the short term, around 112, that's the low from July, would be what I would watch. I think $100 a share, that big round number, and the support from May is the most important line in the sand. Folks, that's our show for today. Thank you so much for joining us today and every weekday for The Final Bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.